Hey, good morning, everyone. Marty Mazzora here, October 17th, 2021, with your weekly macro update. So this morning, I'm going to share with you a handful of charts. Our index did improve week over week. We're at a positive 25, and we're kind of breaking this downtrend that we saw for a while. Then I'm going to dig in a little bit, or maybe a little bit along the way, and talk about sentiment. I want to kind of share with you what I'm hearing in terms of the growing narrative around next year, and of course the bottlenecks and the consumer and what the expectations are and so forth. Frankly, there is just a ton of things to discuss. I scored our index on Friday. It happens to be Sunday morning. And I've kind of struggled with how to present this to you this week, via video or in writing, make it real robust or just kind of brief and to the point. And if I really were to cover all the things I'm thinking about, we'd be spending too much time on a Sunday looking at your screen and listening to me talk. So what I've done is just kind of picked a couple of main points that I think are important. Thought about adding an updated technical analysis, but I want to dig in on the dollar as well as on stocks, maybe on some commodities as well. I am going to touch on commodities here in this macro update. So I will follow up early in the week with a technical analysis update. I'm going to start doing those a little more frequently because I think they're a good insight into short-term expectations. A lot of you I know are watching the market on a daily, if not an intraday basis. And so I can kind of help you gauge some of your short-term expectations just to look at what the charts are telling us in terms of probabilities in the near term. In a nutshell, I think there's reasons to be optimistic, as we talked about here, reasons to be very concerned. I think the risk of a quick, swift decline are there when you look at various sources of leverage underneath the market. Clearly, in the options pit, we're seeing a lot of hedging. What we call this big left tail risk, and that's the risk of something big occurring to the downside. Those of you who are clients who've seen just lots of activity in your portfolio this year, a lot of that has to do with the hedging. Certainly we have been rebalancing, taking profits. We've done a bit of that here in the last few weeks in some areas that have done real well for us, some that are just kind of sitting there that we have some shorter term concerns on. But then there's the hedging with the options contracts, and that's been more active. One of the reasons is hedges, when we go out longer term, are real expensive right now. It's much cheaper to place, say, a 1 month option on an ETF or on the S&P overall than it is to go out 6 months like we have in the past. So if you're seeing that activity and you're wondering what that's all about, some of that's going on. Also, on 2 or 3 occasions lately, some positions that we were pretty heavy in that we really like longer term, we thought were really exposed to some downside moves. So we actually did spend some money on still some short-term options, but we were closer to the price of the ETF. So when indeed they did take a dip, like in September, Nick artfully took back all that we spent in profits, and then we extended the protection out a bit at a little lower level. So essentially on at least a couple, maybe 3 or 4 of our hedges, they turned out to be 100% free when you look at it that way, meaning we bought the option more than doubled when the position declined, took our basis out, and used the profits to extend that meaningful protection out a little further. So folks, we're in the kinds of things that make sense relative to our longer term thesis. But we see all kinds of near-term risk, fourth quarter optimism notwithstanding, particularly in these inflation plays, particularly in commodity-related plays. I'm kind of in that commodity super cycle idea going forward, but I recognize that there are downside near-term risks. And some of these positions, like base metals futures ETF, we're up like 70-80% since we bought it, and we think that's really exposed to a number of factors that could see those things come down, noticeably. So we think it's important to, keep positions that we think make long-term sense, but along the way, spend a little money and hedge them, and that'll be very important. And taking some profits, and those of you taxable investors outside of your retirement plan, absolutely paying some capital gains taxes. where it's necessary. So here's that simple chart of our index. As I said, we kind of bottomed here. We moved back up, went up a few points to 25 on a week-over-week basis. So as I keep saying almost in every blog post, we do not see big risks of recession right here. And therefore, the way we approach the markets traditionally, we don't see big risk of a protracted bear market, because those tend to be things of recessions. Having said that, we have to be very cognizant of why we came bouncing out of there and why we sit here today when by all rights, we should have seen a bigger, longer-term recession, or at least a longer recession with your protracted bear market, which nobody likes, but it would have alleviated a tremendous amount of excesses and froth that, while some would argue because asset prices are up and balance sheets look better, are alleviated. I would not argue that. I would argue that those excesses and those risks are still there. Just because we pumped up asset prices to make balance sheets look better does not mean that we've effectively alleviated the problems that we were identifying way back in here. The Fed does buy anything and everything these days, so that's something that kind of really changes the narrative and how markets should be looked at going forward. But it also should change the narrative on inflation when you dovetail in the impulse for fiscal spending, certainly in the U.S. for the years to come. Okay, starting with retail sales, I did touch on this on the written blog this week. So brick and mortar was better than expected, but still down a little bit year over year, still down on a month over month. The previous month was up 0.90% month over month. We were at 0.7, but again, that was better than expected. The higher frequency Johnson Red Book, or I think it's just called Red Book now. It's kind of in a descending triangle pattern, if you will, but still holding up in there. You could say that's a bull flag if you want to do a technical analysis there. What actually moved our needle a little bit positive was the online sales. You could see we ran up, we kind of consolidated, came down as we reopened and people started going to stores. Well, now we're pretty much at a new high here. Okay, so consumer confidence, this is one I wanted to drill down on just a little bit. So, there's a narrative now, and it's gaining some steam, that stimulus money that goes straight to consumers via transfer payments, that's abating big time, and it's going forward. But the consumers saved a ton of money during the pandemic, and that's going to be hugely bullish going into 2022 as they spend that money. Makes sense. I think this is probably empirical, I suppose. However, one thing, Nick and I were just having this discussion on Friday, and I said, well, the one thing is, let's look at sentiment. Sentiment is rolling over, right? So I don't know that it's a given that if the consumer is feeling less good about his and her circumstances and the economy going forward, if it's a given that they're going to be so willing just to spend willy-nilly that savings that they saved up during last year. In fact, I didn't read through the whole article, but I saw a headline this morning that basically suggested that consumers are going to be stingy with all those trillions of savings that they have here in the US and in Europe on their personal balance sheets. So I think we just need to be careful. We need to be cognizant of the fact and not just go hog wild and think, hey, everything's going to be great and we're going to continue to go to the moon because the consumer's balance sheet looks so good. Well, it does look good, relative certainly to companies which have improved. But again, I kind of told that tale earlier in this talk. Government balance sheet doesn't look good at all, right? But the consumer balance sheet does. A lot of people say, look how healthy the consumer is. Well, the consumer has more of his and her net worth in the stock market than they've ever had. And of course, the equity in their homes keep going up. So sure, they could even pile on debt on a relative basis, but the balance sheet, sure, looks fine. I get it. But boy, what happens if asset markets roll over, right? And again, what if they don't spend that savings like everybody thinks they're going to? I'm not saying they're not, and I'm not saying asset markets are going to roll over. I'm just saying maybe we shouldn't be quite so sanguine amid this very unusual, I think atypical setup that we're going to be having to manage through going forward. Initial jobless claims, I think we touched on that this week in the written blog as well. 293 is a low number. That's good news. Continuing claims continue to come down. Nothing but good news there. And Yeah, sure. We have 10.4 million job openings out there in this country. Now, we are seeing very high quits rates, and that just means people are quitting their jobs, I think, at the highest level since those numbers began being tracked back in 2001. And that's actually considered bullish. People don't quit their jobs unless they have something better to go to, or that they believe they have something better to go to. So lower jobless claims, higher quits rates, several other factors says good things about the prospects going forward. And again, that quits rate kind of flies a little bit in the face of what I just showed you in terms of consumer confidence. So yeah, lots to track, no doubt, going forward. So look at the price of copper. So folks, we track this thing just religiously. For the longest time, I was showing it to you every week and pointing, out these, what you'd call these bull flag patterns, very distinct ones up in here. And right up in here, I virtually promised you, and I even drew lines down in here, that we're going to stay the course on our copper-centric positions, but it had to take a dive. And then, of course, it goes literally straight up here to over $10,000 a ton. So what are we to make of that? Well, the COVID numbers look good. Country by country, there's different stories. The idea that economies are going to come back and they come back strong, in theory, would have a positive impact on copper. But there's also a huge supply and production issues going on across the metals complex. The cost of production, because of the incredibly high cost and shortage of energy, are literally leading to production cuts in many parts of the world, and closing of factories, running factories half time, and so forth, because of the energy dynamics. And of course, if you still have decent demand against cuts in production, well, then you're going to have huge spikes in metals prices. And of course, we're seeing that across the board. Just again, more of under the surface disruptive data that has us really thinking about the whole inflation narrative, short term and long term, and what does this mean? And higher prices are generally the cure for higher prices. Well, for sure, energy prices go up, people are going to use less energy. Metals prices go up, people are going to use less metals. People use less, well, then that's less economic activity and so on. But right now, we're looking at the passing of an infrastructure bill here in the U.S. China is having some real issues, as we know, in their property market. And so a lot of people are forecasting that China's slowdown is going to really ripple through the prices of commodities and global economy and so on. In a minute, I'm going to show you the latest from the Duke University CFO, Chief Financial Officer surveys, and see what the people who make big financial decisions for corporate America are saying about the supply of materials and how long they think it's going to take for these bottlenecks to ease and so forth. So we'll get to that. So let's take a look at one of our own positions that takes advantage of that. And that's DBB, which is that base metals futures ETF. It has gone parabolic, right? Again, not complaining, because this is a not small position for us, particularly as it continues to compound. Look at that buy signal. I mean, we don't have your negative divergences and upward wedges. We had we had kind of a consolidation, a symmetrical triangle in here. We have a 50-day moving average that just keeps going straight up. That's the red line. You kind of lose it with my green trend line right here that I made so bold. So just been living on that upward sloping trend line, bouncing against it, bouncing against the 50-day moving average, and then just shooting straight up. So on our portfolio meeting agenda tomorrow morning, in fact, Nick and I are going to take a very close look at this fund, because this is not going to last. I mean, it's just a little bit of news, and you're going to see these sorts of things turn over. And now again, the dynamics are all there long term. You want to own copper, you want to own these metals, but we're looking at a period of some pretty intense volatility coming off of this rise right here. So we got to take a close look at these positions, make sure we own them in the right quantity, take some off the table like we did oil here the last couple of weeks. Things do not go parabolic and stay there, right? They go and then they correct, and you go down and you retrace, sometimes 50 or 60% of that big move before you start moving up again. I just kind of showed you that in copper just a second ago. And then so that sort of thing will happen in the positions that we have that are things like copper centric. And then lastly, in terms of our chart and what impacts our index, this is the ratio for the main S&P 500 sectors against the S&P 500 itself. So the bottom three are the defensive sectors. They are healthcare, utilities, and consumer staples. Above 100 means they are outperforming the S&P. So they're not. They're underperforming, and this is just the last 30 days, right? Industrials are outperforming. Energy's outperforming. Materials are outperforming. Consumer discretionary is outperforming. Financials are outperforming. Tech actually underperforming just a little bit. But certainly on balance, this is very bullish in terms of what it says about market expectations for the economy going forward. So lastly, and then I'm going to let you go, that CFO survey that I referred to, I just copied and pasted it where I could use it. Sorry about the blurriness of this, but optimism about the U.S. economy, optimism about your own company, rolling over for the second quarter in a row. Optimism toward the U.S. economy, the 9-point decline ranks as the third largest decline on record, behind Q1 2020 and Q4 2008. The 4.7-point decline in the owned company index was the fourth biggest drop on record. Two themes that were heavily focused on in the report's special questions were supply chains, of course, and, of course, labor shortages. Question, are you experiencing any disruptions to your supply chains? Large firms, 74% say yes. 71% of small firms are experiencing disruptions to their supply chains. What is the nature of the disruptions? Material price increases, 64% say that. Production delays, 74% say that. Shipping delays, 78% say that. And availability of materials, just the ability to get what they need, 83% saying they're having trouble getting what they need. Have those disruptions resulted in loss or delayed sales? Yes, some sales were lost and some were delayed. 45% of large firms, 36% of small firms. When do you anticipate these disruptions to be resolved? Folks, these problems that we're talking about right now apparently ain't going nowhere, unfortunately. With regard to employment, are you experiencing difficulty finding new employees? 79% of large firms, yes. 73% yes of small firms. What types of jobs are you experiencing difficulties in? Finding people for routine, manual, non-specialized work, 21%. 30% say non-routine, creative, and specialized work. 49% are saying they are really experiencing hiring difficulties in all types of jobs. How are you responding to hiring difficulties? We're implementing or exploring automation, 39 and 22, large and small respectively. Increasing wages, 89 and 81%. Eliminating product offerings, 14 and 8, large and small. Waiting for the job market to respond, 23% of large companies, 30% of small companies. Other reasons. Average percentage increase in wages by type, get this, 12.6% average for routine, manual, and non-specialized employees. 9.3% for non-routine, creative, and specialized, 9.1% for all jobs. So look at this. So on one end, you have implementing or exploring automation. Of course, automation would be disinflationary, right? Things are cheaper if you can use machines to do it. Increasing wages to the tune of 9% is inflationary by definition. And of course, inflation is what we're seeing. And one of the hottest debates out there that continues is whether inflation is transitory or temporary or structural and longer term. Outlining our narrative and our thesis, we're probably looking at something different in the years to come than we've experienced, and that would be persistent higher inflation for a variety of reasons than we've had the last several decades. And that has us tilting our portfolio to take full advantage of what ultimately becomes a trending weaker US dollar going forward. So folks, that was plenty for a Sunday, so I'm going to leave it there for now. So much more that I'll be circling back with. Please stay tuned. This is important stuff. And for you clients, it just kind of gets you inside of our heads in terms of what we're thinking about, in terms of where there's opportunity, where we're hedging because we see excessive risk in the near term, and just kind of how we're going to be managing your portfolios as we find our way into what is going to be a very interesting future, no doubt. Thank you as always for watching and listening. Talk to you again very soon. Bye-bye.